Welcome to E-Pathshala. I am Padma Gauri, working as an assistant professor in Faculty of Engineering, Avinash Lingam University. Today we are going to learn financial accounting. Accounting has rightly been termed as the language of the business. Like other languages, accounting also communicates the results of business operations to various parties who have taken part of the business, like proprietors, creditors, investors, government and other agencies. The main purpose of financial accounting is to ascertain the profit or loss during a specific period. This period is said to be financial period. Accounting records are required to be maintained to measure the income of the business and communicate the information so that it may be used by managers, owner and other interested parties of the business. Financial accounting. Accounting is a discipline which records, classifies, summarizes and interprets financial information about the activities of a concern so that intelligent decisions can be made about the concern. Bookkeeping is a part of accounting and is concerned with the recording of transactions, which is often routine and clerical in nature, whereas accounting performs other functions as well as like measurement and communication besides of recording. An accountant is required to have a much higher level of knowledge, conceptual understanding and analytical skill than is required of the bookkeeper. The following are the main objective of the accounting. Accounting is done to keep a systematic record of financial transaction. Accounting supplying the following information to the manager or the proprietor. How much the business has in the form of fixed asset, cash in hand, cash at bank, stock of raw material, work in progress and finished goods. The businessman must know about his financial position, that is, where he stands, where he owes and where he owns. The objective is served by the balance sheet or position statement. The balance sheet is a statement of assets and liabilities of the business on a particular date. It serves as barometer for ascertaining the financial health of the business. To ascertain the operational profit or loss, accounting helps in ascertaining the net profit earned or loss suffered on account of carrying the business. This is done by keeping a proper record of revenues and expense of a particular period. Accounting is used to facilitate the rational decision making. It is itself task of collection, analysis and reporting of information at the required point of time to the required level of authority in order to facilitate rational decision making. Accounting functions as an information system for collecting and communicating economic information about the business enterprise. Introduction to finance. Finance has the objective of meeting obligations, preventing insolvency and maintaining credit standing of the enterprise. Many policies are formed for adequate financing of the business. The program concerning finance is presented through the preparation of the cash budget, the capital expenditure budget and the revenue and expense budget. Financial planning. Finance is the area of the business which is concerned with earning of spending, saving or investing, owning, borrowing funds. Total resources of the business are invested partly in fixed asset in the form of fixed capital. The amount of fixed capital is directly related to the system of production to be adopted, the nature of products to be manufactured, and the extent of mechanization to be effected. The term funds mean working capital. Working capital requirements is obtained from the quantity, cost and time of manufacturing. In addition, purchasing and marketing practices cause a significant influence on the estimate of working capital needs. Companies in the work of estimating capital requirements or capitalization, as it is called as direct upshoot of calculating the expected return on investment. As one of the basic objectives of finance is to guarantee a certain minimum return on investments, the company's capital structure must be designed on the prediction of its anticipated income. The amount of capitalization is determined by the totality of all such investments, with the exemptions of short-term investments made through temporary borrowings. All funds invested in the business are computed in what is meant by effective capitalization of the company. Whenever a company cannot pay the usual minimum rate of return, its investment is said to be over-capitalized. On the other side, where company earnings account for more than usual rate, the enterprise is looked upon as an undercapitalized one. Sound financing is to aim at effective capitalization, neither over nor undercapitalization. But effective capitalization is also depend upon determining a correct proportion of securities in the capital structure. Financial policies. Financing is planned and controlled by formulating a number of policies for the guidance of all management members throughout the enterprise. For financial purpose, important policies may be briefly stated as follows. Block capital. Block capital represents the amount invested in land and building, plant and machinery, office and factory equipments, furniture and other form of fixed assets. The investment in fixed asset influences the future success of business to a great extent because these funds are sunk on the period of waiting. Working capital. Working capital is taken to be the excess of current assets over current liabilities. As current liabilities include bank credit and other short-term obligations which go to the amount of current assets to an equal extent. It is shareholders and debenture holders who must be credited with supplying the amount of working capital. Working capital policy centers around the availability of cash for meeting day-to-day expenses and obligations of the business. To ensure a steady supply of cash money, cash planning or budgeting is undertaken so that normal working of the enterprise is not affected despite of the requirements of occasional heavy payments for dividend distribution, purchase of material, acquisition of fixed asset, etc. Depreciation of fixed asset. The policy questions in respect of depreciation rate to the rate of depreciation to be charged and to the investment of depreciation fund to be made in the business. Obviously, such assets are to be depreciated at a heavier rate so as to write off their value within a short period. Depreciation reserve provides the largest single source for the financing of a new plant machinery on the part of established concern. Profit disposition. Policy issues in relation to the profit disposition are concerned with determining the amount of profit to be held back as reserves and amount of profit to be distributed as dividend. Retained profits permit the company to become financially solvent, to improve the market standing of products, to expand production and marketing facilities, and to pay a stable rate of dividend. Internal financing is controlled by policy for dividend distribution. For the fulfillment of one basic financial objective, companies are required to pay a certain minimum return to their investors. In the absence of profit distribution, company can never be assured to having any additional capital from investors in the future. For ensuring a steady supply of capital, companies are therefore required to distribute reasonable dividend among their shareholders. A sound dividend policy is one which calls for the regular distribution of profit at an increasingly higher rate. But policy questions vary according to the nature of the company, whether closely held or publicly held. Organizing for finance. The finance department requires an effective organization structure for performing multi-function activities involved in this area of business. Finance activities are organized according to the nature and size of the business. The process of division and subdivision of activity is a matter of workload and the competence of finance proposal. For a medium-sized concern, the usual organizational arrangement is explained by the diagram. The finance department is generally headed by director or controller. Whatever might be the little, the department head is the finance manager who has an overall responsibility and authority for this segment of the business. As can be observed from the diagram, total activities are divided into three major groups, which are assigned to three different subordinate managers under the title of assistant controllers and the treasurers. The first group of activity is concerned with accounting is placed under the charge of chief accountant who sources necessary coordination in his section. A financial accounting has two important functions: record keeping for shareholders' information and for tax consumption, computation of taxes, etc. It is divided into many parts. The cost accountant is responsible for cost funding and for assisting his superior manager, that is the assistant controller, in the cost control over the whole organization. Under the second group of activities, the work of budgeting, budgetary control and internal auditing is encompassed. Budgetary control is exercised by the second assistant controller with the help of budget section. The internal control section is concerned with internal auditing, which appraises both the operational and financial aspects of the organizational performance. Usually, in addition to giving a general assistance for the exercise of budgetary and cost control, the internal control section reviews policies, procedures and methods so as to keep them in turn with time and circumstances. The last group of activities center around cash handling and credit management in the enterprise. Financial control. Controlling an activity of the finance department of the business are affected by number of tools like budgetary control, cost control, break-even point analysis, profit and loss control, return on investment, internal auditing and ratio analysis. Ratio analysis involves the circulation of both operational and financial ratios. A sample balance sheet should be given. In one side, the capital and liabilities amount are mentioned. The liabilities are split into current liabilities, capital, reserves, etc. And the other side, the assets will be given. Assets are split into current assets and fixed assets. The balance sheet finally balances capital and liabilities amount is equal to assets amount. Accounting equation: assets is equal to liabilities plus capital, or liabilities is equal to assets minus capital. At the end of the financial year, total asset is equal to total sources of finance minus a balance sheet list what a business owns or owes. Ratio analysis. Current assets to current liabilities is said to be ratio analysis. The excess of current assets over current liabilities represents the amount of working capital or net working capital as it is differentially known. Because of the interrelationship, the ratio is also referred to as working capital ratio. Above balance sheet, 1,80,000 divided by 80,000 is the ratio analysis. Cash and bills receivable to current liabilities. The amount of working capital alone cannot indicate the solvency of a business. But the more important question is whether the current assets are held in the liquid form or not. The working capital is tied up in investors and accounts receivable which cannot be converted into cash promptly. The enterprise may fail to honor its obligations for the want of cash funds. As cash is the most crucial component of working capital, current assets which are already realized or easily realizable in the cash are utilized in computing a different ratio of such current assets to current liability. Fixed asset to tangible net worth. The term tangible net worth has a different connection from that of net worth. When the net worth of an enterprise is reduced by the amount of intangible and assets like goodwill, patent rights, preliminary expenses, commission and brokerage on shares, etc. The difference represents the amount of tangible net worth. In the above balance sheet, the net worth of business is 1,80,000, but tangible net worth is 1,70,000. And the ratio figure stands at 70.6%. Current liabilities to tangible net worth. As pointed out in the previous ratio, if fixed asset absorb too great a part of net worth, the enterprise is forced to increase its liabilities, whether current or fixed, for inflating the value of current assets. But increasing current assets through the expansion of current liabilities is a destructive practice and does not improve the net working capital position, because the excess of current assets over current liabilities is what is meant by real working capital. Fixed liabilities to working capital. Effective working capital does not increase by securing funds from short-term loans. On the other hand, it is financed from the net worth and fixed liabilities of the business. It is apparent from the given balance sheet, the net working capital is 1 lakh rupees, which is the difference between current assets and current liabilities. The aggregation of working capital and fixed capital as represented by fixed assets comes to rupees 2,20,000, and this entire amount is financed from the net worth and fixed liabilities of the business. That is, total sum is 1,80,000 and rupees 40,000. Total liabilities to tangible net worth. The ratio of total liabilities, both current and fixed, to tangible net worth explains the relative use of owned funds and borrowed fund in the enterprise. The larger the proportion of borrowed funds to owned funds, the higher becomes the superlative character of the business. Sales to tangible net worth. The ratio of sales to tangible net worth indicates whether sales of the particular year are adequate for the amount of ownership investment or not. Sales to working capital. As a major part of working capital is supplied by owners, it is to be seen by them how sales are related to working capital. Working capital represents the value of net current assets, that is, current assets minus current liabilities. By linking sales to working capital, the use and turnover of assets can be tested and the managerial performance revealed. Sales to finished product inventory. It is the ratio for testing the operating efficiency of an enterprise rather than for funding the inventory turnover of finished products. Since the stock in trade as shown in the balance sheet is valued at the cost price, no effective comparison can be made with sales which are at selling price. Material used in production to material inventory. As investments in raw material absorb a significant part of the capital, this ratio is compiled to see whether materials have been utilized properly or not. Like the inventory turnover of finished products, the turnover of materials inventory is calculated. Net profit to tangible net worth. For all practical purpose, this ratio indicates the return on investment in the business. The summary of financial ratio analysis is given below. Liquidity ratios divided into two, current ratio and asset test ratio. Leverage ratios are fixed asset to net worth, current liabilities to net worth, fixed liabilities to working capital, debit to equity. Operational ratios are equity capital turnover, working capital turnover, inventory turnover, material turnover. Profitability ratios are return on capital. For the each ratios, the industry norms also given as along with the ratios. Conclude the session. Financial accounting aims at providing financial information to people outside the business. In this lesson, we are concerned only with the financial accounting. Financial accounting is the oldest and other branches have to be developed from it. The objects of financial accounting, as stated above, can be achieved only by recording the financial transaction in a systematic manner according to a set of principles. The art of recording financial transactions and events in the systematic manner is known as bookkeeping. In addition with the record of transaction, the recorded information has to be classified, analyzed and presented in a manner in which business results and financial position can be ascertained. Thank you.